Hello and welcome to interest.co.nz. I'm Gareth Vaughan with another of our double shot interviews, and I'm joined by Brad Gordon, who's Senior Investment Advisor at Macquarie Private Wealth. Welcome in, Brad. Good to see you here.
Thank you, Gareth.
Brad's here to talk about 2015 investment opportunities and risks. Now, I thought a great place to start would be, the global economy. So always the driver of everything that happens domestically. What's your take on what's going on around the world at the moment?
Well, the Macquarie view for some time has been we're in a long grinding cycle. So that means we're seeing a lower than trend growth pretty much across the globe, globally, and characterised by low inflation and low growth. So from a company and corporate point of view, it's those companies that can grow top line. Their revenue lines are the ones that are going to succeed in this environment.
Now, you've got an interesting report there with you saying get ready for years of $60 oil. Now, oil's obviously been a real big mover in the last few weeks. I mean, how influential is that going to be in 2015?
Well, the oil is very much a part of everyone's day's lives, and it's very, very important in terms of contributor to inflation. So that's been the game changer, arguably, in recent, not probably weeks, but oil has been on a downward trend for the last 2 to 3 years. But in recent weeks, that downward trend has obviously accelerated. So a weak oil price is going to mean weak inflation. In fact, the biggest term being bandied around now is disinflation. Weak inflation means low interest rates, and low interest rates for longer. If you think where our Reserve Bank is currently sitting now, their biggest quandary is all their model inputs should show inflation, but they're not. And that's the biggest question mark as to how they look out for 2015.
Okay, so if we look more domestically now, New Zealand economy is going along reasonably well, but obviously we've got some concerns. Obviously the dairy price, the dairy forecast payout from Fonterra. We're going to hear more news on that tomorrow, so that's going to be a big factor in 2015. So what are you anticipating locally next year? Yeah,
New Zealand's going to be interesting. What we do think, interest rates will stay low, and you see slowly the longer term swap rates are pulling back. Obviously, commodity inputs are very significant in that. That means housing is probably going to be a strong contributor to the outlook. But you've got the major offsets, which are the commodity prices, and particularly the dairy prices coming off quite significantly. And there is talk that there's quite a lot of stock or inventory build at Fonterra, so that may mean dairy prices stay lower for longer. So that's going to be a real challenge in terms of our terms of trade. But low interest rates should mean property and construction remain positive contributors, and if it is a bit of the unknown, but if immigration remains strong, then again property should perform well.
Okay, now if we look at some of the asset classes, we'll kick off with equities. What are you guys expecting, both domestically and just broadly internationally next year for equities?
We expect divergence. We expect it to be a strong stock picking environment. It's those companies that offer the unique characteristics. One is, as I mentioned earlier, revenue growth. So the companies, we're probably moving a lot to sort of probably the middle cap companies that work or are involved in sort of niche businesses, and some of those, particularly in Australia, something like the realestate.coms and Covermore Group, which is travel insurance, that are rolling out new products and expanding their services into Asia and the like. So there's some quite interesting stories there. The other one obviously has been the yield trade, and a lot of these companies, particularly the utilities, government sell downs post-election, they've really been repriced now that investors feel much more comfortable about the outlook for their sustainability of dividends.
And what about bonds, especially in this environment of low interest rates?
I think the bonds is probably causing the most, head scratching in the industry. There's the market has tightened up this year because there's basically been a very little new issuance. So those investors that are looking to the bond market have had to pay up. that new issuance environment should change in the first quarter of 2015. The Macquarie report in Australia on the banking sector highlighted over the weekend that banks will need to raise further capital. So New Zealand investors should see a lot more probably bank issuance in 2015 in the tier 1 or hybrid space. But in terms of the interest rate outlook, it's a real head scratcher because interest rates are low, but are they going to get lower, and for how long? And it's a really tough one to answer.
Yeah, absolutely. And you already touched on property a bit, but if we go on to that one now, obviously we've had big rises in Auckland residential property especially. Do you expect that to continue next year?
Well, I think it's largely been interest rate driven. There's obviously a number of contributing factors, particularly in Auckland, which is proving relatively efficient market, and that is that there's plenty on the demand side. But I think as people have assumed lower interest rates for longer, their affordability increases quite markedly. So as long as those things stay even, and it does look like interest rates are going to stay low, then the Auckland property market should be well supported.
And what about the currencies world? I mean, it's been a pretty topsy-turvy one with the New Zealand dollar this year. What are you guys anticipating next year? Obviously, the Fed has ended its bond buying or its quantitative easing, but there's suggestions they may raise interest rates, but maybe that's looking a bit less likely now.
Well, like the Reserve Bank of New Zealand, the Fed Reserve is looking at what should be a inflationary environment, but it's not, and obviously oil prices coming off so significantly recently is only going to elongate that. So yes, everyone does expect that interest rates will go up in the US in 2015. The timing is pretty uncertain, and that will be well watched. From a currency perspective, I mean, I think our currency probably is too high, particularly with the terms of trade coming off so significantly. But I think from a currency perspective, the most likely outcome is we're going to see increased volatility as central banks try and work out how to, I guess, act in this environment, and particularly the Fed Reserve, just as to when interest rates go up over there.
And just finally, I mean, we've touched on a wide range of topics and issues here. I guess if you were going to just single out, a couple of them as real key factors for investors to watch next year, what would they be?
I think from an investor perspective, the biggest game changer is oil prices. So, and what that does is actually gives most other stocks a boost. So oil prices is a big contributor to everything as mentioned. It impacts interest rates, but it also impacts the consumer. So if we see energy prices stay low, and we expect they will, we're now forecasting $60 oil for years to come, that should have ramifications for a number of other sectors. And you would hope actually from looking at a New Zealand perspective that retail should get a bit of a boost too.
Well, thanks a lot for that, Brad. That's Brad Gordon, Senior Investment Advisor at Macquarie Private Wealth, and I'm Gareth Vaughan at interest.co.nz.